Hey there, investors! Almost 4 billion people, half the world's population. That's the reach of Meta platforms. But today, investing in Meta means investing in a paradox. On one side, we have one of the most profitable advertising machines in history, now supercharged by artificial intelligence that generates tens of billions in profit. On the other, a personal, controversial, multi-billion-dollar gamble by its founder on the metaverse, which burns money at an astonishing rate. And most importantly, thanks to a special stock structure, there's only one person who can decide the company's fate: Mark Zuckerberg. And that's where things start to get interesting and risky for investors at the same time. The question for investors is, do you believe in the advertising business, a money-making machine, or in its founder? In this video, we'll analyze Meta. We'll explore 1. The two-faced strategy, how AI generates money today, and its promises for the future, in direct contrast to the risk of the metaverse. 2. The financial fortress, the solid foundation that allows Meta to make these bold bets. 3. The moat and the central risk, the company's competitive advantage and the governance risk posed by Zuckerberg's control. Stay with us to understand the battle that will define Meta's future. Meta's two-faced strategy. Meta's strategy is to use a huge source of money to fund a very expensive dream. Let's understand both parts of this equation. The AI-powered money machine. First, the family of apps: Facebook, Instagram, WhatsApp. The business model is advertising, and artificial intelligence is its new rocket fuel. To power this AI, Meta plans to spend up to $72 billion by 2025. A huge part of this money will go to buying tens of thousands of NVIDIA AI chips and building data centers. This massive investment pays off in two ways today: by improving your feed with Reels to keep you engaged, and with tools like Advantage Plus, which use AI to find customers for advertisers with amazing efficiency, making them spend more money on the platform. Future prospects, where AI can take Meta. The $72 billion isn't just for making today's ads better. Meta is planting the seeds for new AI-based business models. First, the Meta AI Assistant. It's already built into WhatsApp, Messenger, and Instagram. The goal is clear: create an assistant so helpful that you never need to leave Meta's apps. You'll be able to plan trips, ask for recommendations, create images, and eventually buy products and services directly through a chat. Future money from this could come from APIs, software that talks to each other and shares information, for businesses, e-commerce transactions, or sponsored results. Second, generative AI for businesses and creators. Imagine AI tools that let a small business create a whole marketing campaign: videos, images, text, with just a few clicks, all within the Meta ecosystem. This could become a new subscription revenue stream, SaaS. And finally, AI is the bridge to the metaverse. A huge and interesting virtual world can't be built by hand. Generative AI will create much of these worlds, avatars, and characters, making the metaverse vision technically possible. The metaverse, the expensive and controversial bet. And this brings us to the other side of Meta, Reality Labs. This is where a big part of the spending and Zuckerberg's focus goes. But the financial results are brutal. Look at these numbers. Based on recent data, we can expect Reality Labs to continue losing about $4 billion in one quarter of 2025. Since 2020, the total losses are already over $45 billion. It's a money pit that's only possible because of how financially strong the other half of the company is. Financial strength that funds ambition. How can a company burn $4 billion in a single quarter on a risky project and still be seen as financially strong? The answer lies in the strength of its main business. Let's look at the actual numbers. Rock-solid balance sheet. Looking at Meta's balance sheet, we see a position that many would envy. By mid-2025, the company will have about $58 billion in cash and short-term investments. On the other side, its total long-term debt is about $18 billion. Doing some quick math, this means Meta operates with a net cash position of about $40 billion. It could pay off all its debt and still have $40 billion left over. This flexibility is a powerful strategic weapon, the cash-generating machine. But the most important number is free cash flow. This is the money left over after paying all bills and investments. Meta's advertising business is so efficient that in a single quarter, it can generate over $12 billion in free cash flow. Compare that to Reality Labs' $4 billion loss. The family of apps generates more than enough cash to cover the metaverse's hole and still have plenty left over. It's this mountain of money that allows Zuckerberg to plan $72 billion in spending. Returns to shareholders, a sign of maturity. The main business is so profitable that, even after funding all these ambitions, there's still money left over. That's why Meta has increased its returns to shareholders through stock buybacks and its new dividend. A strong sign that despite the futuristic bets, the core business is stable and mature. The competitive moat, the unreal fortress. This financial strength didn't just appear out of nowhere. It's protected by one of the most powerful competitive moats in the business world. Let's look at the three main pillars that make Meta's core business so strong. 1. The impenetrable network effect. The main pillar of Meta's moat is the network effect. Think about it. You're on Instagram, Facebook, and WhatsApp because your friends, family, and the businesses you follow are there too. The more users a platform has, the more valuable it becomes for everyone, creating a good cycle that's almost impossible for a new competitor to break. With almost 4 billion users across its family of apps, Meta doesn't just have a moat, but an ocean separating it from any challenger. 2. The overwhelming data advantage. Every like, every share, every message, and every ad clicked over almost 2 decades has generated a huge amount of data about human behavior that no other company in the world has. This data feeds its artificial intelligence. And it's this data advantage that allows Advantage Plus to be so efficient for advertisers and makes Reels so addictive for users. A competitor might even have better technology, but without the data, they can't compete at the same level of personalization and effectiveness as Meta. 3. Switching costs and established brands. Finally, there are the behavioral switching costs. Leaving Instagram or Facebook means abandoning years of photos, memories, and social connections. Leaving WhatsApp means isolating yourself from the main form of communication in many countries. Plus, brands like Instagram and WhatsApp are priceless assets. Together, these factors keep users within the ecosystem, ensuring long-term cash generation. Risks and uncertainties. The dilemma of the lone man. No moat is impossible to cross, and every investment carries risks. In Meta's case, they are significant. But one stands out as the main risk, which makes all the others bigger. The central risk, Zuckerberg's absolute power. Here's the most important point of the argument. Meta has a dual-class stock structure. The shares you and I buy, Class A, have 1 vote. Mark Zuckerberg's shares, Class B, have 10 votes each. The result? He holds the majority of the voting power and, therefore, absolute control over the company. Think about the $72 billion in spending and the $40 billion in net cash. It's Zuckerberg who decides alone how to use this firepower. If all other investors in the world voted to reduce the billions burned in reality labs, their decision wouldn't matter. His will would win. This turns a business risk into a deep governance risk. Secondary, but real risks. Zuckerberg's control is the umbrella under which other important risks exist. Execution risk in the metaverse. The huge gap between niche and mass. The execution risk in the metaverse isn't just whether the technology will work, but whether the audience for it will appear on the scale that the investment needs. Right now, the metaverse isn't empty, but its audience is small. It mainly attracts young consumers, tech fans, and gamers, who are the main users of the Quest headset. Besides them, there's a growing group of creators, developers, and some companies that use the technology for training, design, and remote collaboration. And here's the main problem. Meta isn't investing tens of billions of dollars a year to serve a small group, no matter how engaged they are. The strength of the family of apps comes from its wide appeal, reaching almost half the planet of all ages and types. The bet on the metaverse only pays off if it also gets a lot of people to use it, going beyond gamers and businesses to become an essential platform for the daily lives of billions of people. The risk, therefore, is that the metaverse may never make this jump from niche to mass. It might even become a sustainable business for games and companies, but that would be a tiny result compared to the huge amount of money that has been and continues to be poured into the project. It would be like building the biggest and most expensive highway in the world just to serve a small village. Regulatory risk. Governments around the world are watching Meta, with threats of antitrust lawsuits, stricter privacy laws, and billions in fines. A bad regulatory decision can greatly affect the main business. Competitive risk. Meta's moat is wide, but not endless. TikTok proved that it's possible to get the attention of hundreds of millions of users. The fight for user attention is constant and fierce. The thing is, the company's answer to all these challenges, competition, regulation, and the need to take the metaverse from niche to mass, depends in the end on the vision and decisions of one person. Conclusion. So, after this analysis, how do we sum up Meta as an investment? On one hand, you're buying the protected profit machine, a digital monopoly with a formidable competitive advantage, $40 billion in net cash, that generates over $12 billion in free cash flow per quarter and is using AI to get even stronger. On the other hand, you're funding the founder's bet. You're betting tens of billions on a speculative project, the metaverse. A project that so far has only attracted a niche audience, while the investment assumes a global revolution. And you're doing this under a structure where a single person has absolute control over all this money and the company's future. In the end, investing in Meta comes down to this question. Do you trust Mark Zuckerberg's long-term vision more than you trust the current numbers? Do you believe that the competitive advantage and the power of AI are enough of a safety net to back a visionary bet that may or may not turn a niche product into the next universal platform, justifying the massive spending? Or do you see a founder risking a spectacular business on a project that may never go beyond its current limits, all without any checks and balances? Your answer to this question decides whether Meta is a buy, sell, or hold for you. What's your answer? Leave your thoughts in the comments. We want to know how you see this battle within Meta. If you like this analysis, please like the video and subscribe for more content. Thanks for watching and happy investing.